History doesn't repeat, but it rhymes so perfectly that the echo can make you wealthy beyond imagination, or it can destroy you. 96 years ago, in the autumn of 1929, the greatest wealth transfer in American history unfolded over exactly 8 weeks, from the peak of euphoria to the depths of despair, from paper millionaires to breadlines, from irrational exuberance to generational devastation. But here's what they never teach you in the history books. While 90% of Americans watched their wealth evaporate, while the titans of Wall Street jumped from windows, while the banking system collapsed in slow motion, a small group of people became fabulously, obscenely wealthy. They didn't get lucky. They read the playbook. They recognized the pattern. And they positioned themselves on the right side of the collapse before the first domino fell. That playbook is open again. The same patterns that preceded the 1929 crash are appearing right now in the precious metals market. The same institutional behaviors, the same retail psychology, the same leverage ratios, the same disconnect between paper and physical reality. For 6 months, I have been documenting these parallels on this channel. I have shown you the data. I have walked you through the mechanics. I have warned you that the 8-week window is approaching. That window has opened. Not next year, not next quarter. The 8-week countdown started 3 weeks ago when silver touched $85 and then mysteriously, violently collapsed 18% in 72 hours. The mainstream called it a correction. The algorithms called it profit-taking. I call it the playbook. Because in 1929, the same pattern played out. A violent shakeout designed to separate weak hands from their positions before the real move began. An 8-week period of chaos, fear, and manufactured panic that transferred wealth from those who did not understand history to those who had memorized every page. By the end of this video, you will understand exactly what happened in those 8 weeks of 1929. You will see the precise parallels to today as silver market, and you will have the roadmap that created millionaires from the ashes of that collapse. Welcome to Chronicles of Currency. The playbook is open. Let's read it together. I'm your host, and this is the channel where we decode monetary history to understand monetary future. We don't chase headlines, we trace patterns, because the patterns always repeat for those patient enough to recognize them. What you're about to hear is not speculation. It is historical analysis applied to present conditions. Every parallel I draw is documented. Every data point is verifiable. Every prediction is based on the mathematical inevitability of patterns that have played out across centuries of monetary history. I spent the last 3 weeks buried in Federal Reserve archives from the 1920s. I pulled trading records from the New York Stock Exchange. I studied the memoirs of Jesse Livermore, Bernard Baruch, and Joseph Kennedy, the men who saw the 1929 crash coming and positioned themselves to profit from it. What I found was not just interesting, it was terrifying, because the conditions that preceded the 1929 collapse are not similar to today. They are identical. The leverage ratios in the commodity markets match 1929 levels. The disconnect between paper instruments and physical assets mirrors exactly. The retail euphoria, followed by sudden violent corrections, follows the same trajectory. And most importantly, the behavior of the major institutions, the banks, the clearinghouses, the Federal Reserve, they are running the exact same playbook they ran 96 years ago. History has given us a gift, a preview of coming attractions, a cheat sheet written in the blood of our great-grandparents' generation. The question is whether you will use it. In the next 40 minutes, I'm going to walk you through the 8-week pattern of 1929. I'm going to show you exactly where we are in that pattern today. And I'm going to reveal how a small group of investors are positioning themselves right now to emerge from this chaos as the new millionaires. Let's go back to October 1929. To understand what's happening in silver today, you must first understand exactly what happened in the autumn of 1929. Not the simplified version they taught you in school, the real version. The week-by-week breakdown of how wealth was systematically transferred from the many to the few. Week 1, September 3rd to September 10th, 1929. The market hit its all-time high. The Dow Jones reached 381.17. Newspapers declared a new era of permanent prosperity. Irving Fisher, the most famous economist in America, announced that stocks had reached a permanently high plateau. Retail investors were euphoric. Margin debt had reached unprecedented levels. Everyone from taxi drivers to shoeshine boys was buying stocks on leverage. But something strange happened in the commodity pits that week. Silver, which had been rallying alongside stocks, suddenly dropped 7% in 3 days with no news catalyst. The mainstream financial press ignored it, but the insiders noticed. Bernard Baruch, the legendary financier, later wrote in his memoirs that this silver drop was his first warning sign. He began quietly liquidating his stock positions that week, while publicly expressing optimism. Week 2. September 11th to September 17th. The stock market wobbled but recovered. Retail investors bought the dip. They called it a healthy correction. The leverage increased further, but in the commodity markets, silver dropped another 5%. The open interest in silver futures collapsed by 30% as smart money exited their positions entirely. Jesse Livermore, the greatest trader of his era, began building a massive short position in stocks during this week. He later testified that the silver market's behavior told him everything he needed to know about what was coming. Week 3, September 18th to September 24th. The first real crack appeared. The Hatry Group, a major British financial conglomerate, collapsed. The London markets panicked, but American investors dismissed it as a foreign problem. Silver dropped another 8%. The total decline from the peak was now 20%. Dealers began reporting that physical silver was disappearing from the market. Premiums started to rise even as the paper price fell. Sound familiar? Week 4, September 25th to October 1st. The stock market made a final desperate rally. The Dow recovered most of its losses. The newspapers declared the crisis over. Retail investors who had sold in fear bought back in, often at higher prices than they had sold. But the silver market told a different story. The paper price continued falling while physical premiums exploded. The disconnect between the futures market and the physical market reached levels not seen since the panic of 1907. Week 5, October 2nd to October 8th. The slow bleed began. Stocks dropped 2% to 3% each day. Not enough to trigger panic, but enough to erode confidence. Margin calls started. Retail investors, overleveraged and overconfident, began to feel the squeeze. Silver's paper price stabilized, but the physical market went dark. Dealers stopped quoting prices. The bid-ask spread widened to levels that made trading impossible. Week 6, October 9th to October 15th. The cascade began. Major banks started calling loans. Investors who had borrowed to buy stocks were forced to sell. Each sale pushed prices lower, triggering more margin calls, forcing more sales. Silver's paper price crashed 15% in a single week. But here's what the history books don't tell you. During this week, physical silver completely disconnected from the paper price. While futures showed silver at 0.45 per ounce, physical dealers were charging 0.65 and refusing to sell more than small quantities. Those who understood what was happening bought every ounce they could find. Week 7, October 16th to October 23rd. The dead cat bounce. Stocks rallied 10% in 2 days. The newspapers declared the worst was over. Retail investors, desperate to believe, bought back in. It was a trap. The smart money used this rally to complete their exit. They sold their remaining stock positions into retail buying and converted the proceeds into physical assets: gold, silver, farmland, anything tangible. Week 8, October 24th to October 29th. Black Thursday, Black Monday, Black Tuesday, the final collapse. The Dow dropped 25% in 5 days. Billions of dollars in wealth evaporated. The banking system froze. The Great Depression began. But for those who had read the Playbook, for those who had watched the silver market's warnings, for those who had converted paper to physical in weeks 4 through 7, this was not a tragedy. It was the greatest buying opportunity of the century. Over the next 4 years, they bought assets for pennies on the dollar. They acquired companies, real estate, and commodities at prices that would never be seen again. Joseph Kennedy turned $4 million into $180 million. Jesse Livermore made $100 million in a single month. Bernard Baruch's net worth increased fivefold during the Depression. They read the Playbook. Now let me show you how that playbook is repeating in silver right now. Let me map the 1929 timeline onto the current silver market. When you see the parallels, you will understand why I believe we are in the most critical 48 to 72 hours of this entire cycle. Our week 1 equivalent occurred 6 weeks ago when silver touched 85.47 on the COMEX futures. The retail community was euphoric. Social media exploded with predictions of $100 silver by Christmas. Leverage in the futures market reached levels not seen since the Hunt brothers squeeze of 1980. And then, just like September 1929, silver suddenly dropped 7% in 3 days with no fundamental catalyst. The mainstream called it profit-taking. It was the first warning. Our week 2 played out over the following 10 days. Silver bounced weekly, convincing retail traders that the worst was over. But the open interest data told a different story. The smart money, the commercials, the bullion banks, they were exiting their short positions at a pace not seen in years. They weren't covering because they were scared. They were covering because they knew what was coming. Our week 3 hit 2 weeks ago. Silver collapsed another 11% in 5 trading days. The total decline from the peak exceeded 18%. Retail traders panicked. The forums and comment sections filled with despair. But here's what the mainstream didn't report. While the paper price was collapsing, physical premiums were exploding. Dealers who had been selling American Silver Eagles at $4 over spot were suddenly charging $12 over spot. Some dealers stopped selling entirely. The disconnect between paper and physical had begun. We are now in the equivalent of week 4. And this is where it gets critical. In 1929, week 4 was the false recovery. The moment when the market made one last rally, convincing the weak hands to buy back in just before the real collapse began. Look at what happened in silver over the past 72 hours. The price bounced 8% from the lows. The mainstream financial media is declaring the correction over. Retail traders are buying the dip with leverage. But the physical market is telling a completely different story. I called 6 dealers yesterday. 3 of them have no silver eagles in stock at any price. 2 of them quoted prices that translate to $95 per ounce, a $13 premium over the paper price of $82. One of them told me, and I quote, "We are not selling, we are buying. We think the paper price is wrong." This is exactly what happened in week 4 of 1929. The paper market rallied. The physical market disappeared. The disconnect widened to levels that signaled an imminent break. If the pattern continues, weeks 5 through 8 will bring the final shakeout. A violent paper crash designed to trigger every stop loss, margin call every leveraged trader, and create the maximum possible fear before the physical reality reasserts itself. Those who understand the playbook will use this crash to accumulate physical metal at paper prices that will never be seen again. Those who don't understand will panic, sell into the crash, converting their real wealth into paper promises just as those paper promises become worthless. The 8-week window that created Millionaires in 1929 is open again, and we are in week 4. Let me explain exactly how this wealth transfer mechanism works, because it's not magic, it's not luck. It's a mathematical process that has repeated in every major financial crisis for 300 years. The mechanism has 4 phases. Phase 1 is the leverage buildup. In the years before a crash, easy credit encourages speculation. Investors borrow money to buy assets. This leverage amplifies gains on the way up, creating the illusion that everyone is a genius. In 1929, margin requirements were just 10%. You could buy $100 worth of stocks with just $10 of your own money. This meant that a 10% gain doubled your investment. Today, the leverage in silver futures is even more extreme. The margin requirement for a 5,000-ounce silver contract is approximately $8,500. At $82 per ounce, that contract controls $10,000 worth of silver. That's 48-to-1 leverage. A 2% move against your position wipes out your entire margin. Phase 2 is the distribution phase. The smart money, the insiders, the institutions with access to information that retail investors don't have, they begin quietly selling their positions into retail buying. They don't announce their exit. They don't crash the market. They slowly, methodically distribute their holdings to the greater fools. This is exactly what the COT, the Commitment of Traders data, has shown in silver for the past 6 weeks. The commercials, the big banks, have reduced their short positions by 40%. They are not adding new shorts at these levels. They are stepping back from the market. When the smart money stops playing, it's because they know the game is about to change. Phase 3 is the crash. Once the smart money has distributed their positions, they stop supporting the price. The artificial buying that was propping up the market disappears. At the same time, they may actively short the market to accelerate the decline. The leverage that amplified gains on the way up now amplifies losses on the way down. Margin calls force liquidation. Forced liquidation crashes prices further. A cascade begins. This is the phase that destroys retail investors. They bought on leverage expecting prices to rise. Now prices are falling. They can't meet margin calls. Their positions are liquidated at the worst possible moment. In 1929, this phase wiped out an estimated $30 billion in wealth, the equivalent of $500 billion today. But here's the secret. Phase 3 is not the end. It's the opportunity. Phase 4 is the accumulation phase. When the crash is complete, when the leverage has been purged, when the weak hands have been wiped out, assets trade at prices far below their intrinsic value. The physical reality hasn't changed. Mines still produce silver. Industry still needs silver. The fundamentals are identical. But the price is 50% lower. This is when the smart money buys. In 1929, those with cash and conviction bought stocks at 90% discounts. They bought real estate for cents on the dollar. They accumulated physical commodities at prices that reflected panic, not reality. The wealth didn't disappear in the crash. It was transferred from those who sold in fear to those who bought with conviction. This is the mechanism. This is the playbook. And it is executing right now in the silver market. The leverage is extreme, 48-to-1 in the futures market. The distribution is underway. The KOT data proves it. The crash has begun. Silver down 18% from the peak. The accumulation opportunity is opening. The question is which side of this wealth transfer you will be on. Will you be the retail investor who sells physical silver because the paper price is falling? Or will you be the student of history who recognizes the pattern and accumulates while others panic? The playbook is open. The mechanism is in motion. The 8-week window is your opportunity. Let me quantify this opportunity, because I want you to understand the mathematical magnitude of what is at stake. In 1929, the investors who positioned correctly saw returns of 20 to 50 times their initial investment over the following decade. Not percent, times. Joseph Kennedy's $4 million became $180 million. That's a 45x return. Jesse Livermore's $5 million stake became $100 million. That's a 20x return. Bernard Baruch turned $10 million into $50 million. That's a 5x return in the worst economic conditions in American history. These weren't gamblers. They were historians. They understood the playbook, they recognized the pattern, and they had the conviction to act when everyone else was paralyzed by fear. Now let's apply this math to silver. If silver completes the 1929 pattern, we should expect the paper price to drop another 20% to 30% from current levels during weeks 5 through 8. That would take the spot price to approximately $58 to $66 per ounce. This will be the maximum fear moment. The headlines will scream that silver is crashing. The retail forums will be filled with capitulation. The mainstream media will declare that the silver bull market is over. But the physical market will tell a different story. Just as in 1929, the physical premium will explode during this phase. Dealers will quote prices of $80, $90, or higher for actual metal. Even as the paper price shows $60, the disconnect will reach levels that seem impossible. This disconnect is the signal. It tells you that the paper price is a lie and the physical price is the truth. Those who buy physical silver at $80 during the crash phase, when the paper price says $60, will feel like they're overpaying. They will doubt themselves. Their friends will mock them. But when the paper market finally breaks, when the COMEX is forced to acknowledge physical reality, when the price resets to match the actual supply and demand, silver will trade at $150, $200, or higher. Let's do the math on a specific scenario. Assume you buy 100 ounces of physical silver at an average price of $85 per ounce during the accumulation phase. Your total investment is $8,500. If silver resets to $150 per ounce, a conservative target based on inflation-adjusted historical highs, your 100 ounces are worth $15,000. That's a 76% return. If silver reaches $200, your holdings are worth $20,000. That's a 135% return. If silver reaches the true inflation-adjusted high from 1980, approximately $300 in today's dollars, your holdings are worth $30,000. That's a 253% return. But here's the asymmetry that makes this trade so compelling. If silver goes lower, if the paper price crashes to $50, but you hold physical metal, you have lost nothing. You still have 100 ounces of silver. The physical metal doesn't care what the future screen says. It exists. It has industrial value. It has monetary value that has been recognized for 5,000 years. You can hold it indefinitely until the market recognizes its true value. The downside is temporary paper losses. The upside is generational wealth. This is the risk-reward profile that created Millionaires in 1929. An asymmetric bet where the upside is unlimited and the downside is merely patience. The math is clear. The pattern is clear. The opportunity is clear. The only question is whether you have the conviction to act. Now I need to explain why. Despite the clarity of the pattern and the simplicity of the math, 90% of people will fail to capitalize on this opportunity because the playbook is not just about economics. It's about psychology. And the psychology of a crash is specifically designed to make you do the wrong thing at the wrong time. In 1929, the people who lost everything were not stupid. They were bankers, lawyers, doctors, businessmen. They were educated. They were successful. They had access to the same information as the people who profited. They failed because they could not overcome 3 psychological barriers. Barrier 1 is recency bias. When you've seen prices rise for years, your brain assumes they will continue to rise. When they suddenly fall, your brain treats it as an anomaly, a temporary setback that will correct itself. This is why retail investors bought the dip in week 4 of 1929. They couldn't believe the boom was over. They assumed the rally would resume. It didn't. Barrier 2 is social proof. When everyone around you is panicking, your brain tells you that they must know something you don't. When the headlines scream crash and your friends are selling, the pressure to conform is almost irresistible. This is why retail investors sold at the bottom in weeks 6 through 8 of 1929. They followed the crowd over the cliff. The smart money was buying from them. Barrier 3 is loss aversion. The pain of a loss is psychologically twice as powerful as the pleasure of an equivalent gain. When you're down 20%, your brain screams at you to stop the pain, to sell, to make it stop. This is why leverage is so dangerous. It amplifies losses to the point where the psychological pain becomes unbearable. Investors sell not because it's rational, but because they can't stand the feeling anymore. The smart money understands these barriers. They don't fight human psychology, they exploit it. They know that when they crash the paper price, the retail investors will panic. The leverage will force liquidation. The recency bias will prevent buying. The social proof will encourage selling. The loss aversion will make it impossible to hold. This is not a bug in the system. It is the feature. It is how wealth is transferred from those who react emotionally to those who act strategically. If you want to be on the winning side of this wealth transfer, you must overcome these three barriers. You must reject recency bias by studying history, by recognizing that crashes happen and that this pattern has repeated for centuries. You must reject social proof by developing your own conviction, by understanding the fundamentals so deeply that you can ignore the crowd. You must reject loss aversion by eliminating leverage, by only investing what you can afford to hold through the chaos, by focusing on the long term rather than the daily fluctuations. The playbook is clear, but reading the playbook is not enough. You must have the psychological strength to execute it. Let me tell you about the three men who saw 1929 coming and how they positioned themselves to profit. Their strategies were different, but their understanding of the playbook was identical. Jesse Livermore was a trader. He made his fortune by reading market psychology and betting against the crowd at turning points. In September 1929, Livermore noticed that the commodity markets, particularly silver and cotton, were behaving strangely. Prices were falling despite strong fundamentals. Volume was declining as smart money exited. The technical patterns matched previous crashes he had studied. He began building a massive short position in stocks, while everyone around him was buying. On October 29th, Black Tuesday, while millions of Americans watched their wealth evaporate, Livermore made $100 million in a single day. It was the largest single-day profit in Wall Street history at that time. His secret? He studied the playbook, he recognized the pattern, and he had the conviction to act against the crowd. Bernard Baruch was an investor and advisor to presidents. He was known as the lone wolf of Wall Street for his willingness to take contrarian positions. In August 1929, Baruch began quietly liquidating his stock positions. He didn't announce his selling. He didn't try to warn the public. He simply converted his paper wealth into cash and physical assets. By the time the crash hit, Baruch was fully liquid. He spent the next 4 years buying assets at depression prices, stocks, real estate, commodities. He acquired companies for less than their cash in the bank. By 1935, his net worth had increased fivefold despite, or rather because of, the worst economic collapse in American history. His secret? He watched the silver market. He later wrote that the disconnect between paper commodity prices and physical reality was his clearest warning signal. Joseph Kennedy was a speculator and the father of a future president. He was ruthless, immoral, and brilliant at reading markets. Kennedy's famous quote about the shoeshine boy giving him stock tips is well known, but less known is what he did with that insight. He didn't just sell his stocks. He went short. He borrowed stocks and sold them, betting they would decline. When the crash hit, he bought them back at a fraction of the price and pocketed the difference. He then used his profits to buy real estate, movie studios, and political influence. The Kennedy fortune that produced a president was built on the wreckage of 1929. His secret? He understood that when the uninformed are euphoric, the end is near. He studied the playbook of previous crashes and recognized the pattern. 3 different men, 3 different strategies, one common thread. They all studied history. They all recognized the pattern. They all had the conviction to act when everyone else was frozen. The playbook is the same today. The pattern is the same today. The opportunity is the same today. The only question is whether you will study, recognize, and act. Before I give you the roadmap, I need to stop and acknowledge what this moment means for those who have been preparing. If you are watching this channel, if you have been stacking silver while your friends bought meme stocks, if you have been studying monetary history while the mainstream chased the latest fad, this is your vindication. For years, they called you a doom-and-gloomer. They said precious metals were relics. They said the paper system was invincible. They mocked your silver stack while they leveraged themselves to buy overpriced assets. The pattern you recognized is playing out. The playbook you studied is executing. The preparation you made is about to pay off. The 8-week window is not a threat to you. It is a gift. It is the opportunity to accumulate more physical metal at paper prices that will never be seen again after the reset. While the leveraged speculators are wiped out by margin calls, you will be buying. While the weak hands panic sell at the bottom, you will be accumulating. While the mainstream declares precious metals dead, you will be loading the boat. This is what you prepared for. This is why you studied history. This is the moment when patience is rewarded and conviction is vindicated. The millionaires of 1929 were not lucky. They were prepared. They understood the playbook. They positioned themselves before the crowd understood what was happening. You have the same opportunity, the same playbook, the same patterns, the same 8-week window. What you do with it is your choice, but know this. Your preparation was not in vain. Your study was not wasted. Your patience is about to be rewarded in ways that the paper holders cannot imagine. The wealth transfer is underway, and you are on the right side of history. Let me give you a specific, actionable strategy for navigating the next 8 weeks. Week 4 is now. This is the false recovery phase. Your action: do not buy the dip in paper silver. Do not add leverage. If you have leveraged positions, reduce them now while you can do so profitably. Instead, use this rally to acquire physical metal. The premiums are high, but the metal is still available. Every ounce you secure now is an ounce you won't have to fight for later. Weeks. 5 and 6 will be the cascade phase. The paper price will likely fall sharply. Headlines will turn bearish. The mainstream will declare the silver bull market dead. Fear will be maximum. Your action: do not panic. Do not sell physical metal. This is the phase where wealth is transferred from weak hands to strong hands. If you have dry powder, meaning cash specifically reserved for this purpose, begin deploying it in tranches. Buy physical silver at 20% down from the peak. Buy more at 30% down. Buy more at 40% down if it goes that far. Do not try to catch the exact bottom. Spread your purchases across the fear phase. Weeks. 7 and 8 will be the capitulation and reversal phase. This is when the paper market breaks. The disconnect between paper and physical will become undeniable. The mainstream will finally acknowledge what the physical market has been saying all along. Your action: hold your position. Do not sell into the first rally. The first rally is just the beginning of the repricing. Watch the premium as your signal. When physical premiums collapse back to normal levels, 3% to 5%, it means the paper market has finally caught up to physical reality. Until then, the paper price is still lying. After week 8, we enter the new paradigm. The price reset will be violent and permanent. Silver will trade at levels that reflect the true supply and demand dynamics, not the paper manipulation. Your action: hold for the long term. Do not sell for paper currency that is being devalued to bail out the banks. If you need liquidity, borrow against your metal rather than selling it. Consider converting some gains into other real assets: productive land, essential businesses, other commodities. Diversify your real wealth across multiple categories. The key to this entire strategy is eliminating leverage. Leverage is what kills investors in crashes. It forces you to sell at the bottom when you should be buying. It takes the decision out of your hands. If you're holding physical silver with no debt against it, you cannot be forced to sell. You can wait out any paper price decline indefinitely. Time is on your side. If you're holding leveraged futures or options, you're playing into the hands of those running the playbook. You will be liquidated at the exact moment that creates the maximum profit for the other side. The 8-week window is your opportunity. But it is only an opportunity if you have the positioning to capitalize on it. Reduce leverage, accumulate physical, hold through the chaos. This is the strategy that created Millionaires in 1929. It will create millionaires again. Let me leave you with this. 96 years ago, a small group of investors recognized a pattern. They studied history, they understood the playbook, and they had the conviction to act while everyone else was paralyzed by fear. That pattern is repeating. The leverage ratios match 1929. The paper to physical disconnect matches 1929. The institutional behavior matches 1929. The 8-week window is opened. I cannot tell you exactly what price silver will reach. I cannot tell you the precise day the paper market will break. I cannot give you a guarantee that this pattern will complete exactly as it did 96 years ago. But I can tell you this: the fundamentals of silver are stronger than they were in 1929. The industrial demand is greater. The above-ground stockpiles are lower. The currency debasement is more extreme. If the pattern completes, the repricing will be violent. Those holding physical metal will see their wealth multiply. Those holding paper promises will see their wealth evaporate. The wealth transfer is underway. The playbook is open. The 8-week window is your opportunity to position yourself on the right side of history. Study the pattern, understand the mechanism, overcome the psychological barriers, execute the strategy. This is Chronicles of Currency. We don't chase headlines, we trace patterns. And the pattern that created Millionaires in 1929 is executing right now in the silver market. The question is not whether the wealth transfer will happen. The question is which side of that transfer you will be on. The window is open. I'll see you on the other side. If you found value in this historical analysis, subscribe to Chronicles of Currency and hit the notification bell. We're going to be tracking this 8-week window in real time with updates as the pattern progresses. Drop a comment below. Are you prepared for the cascade phase? Have you reduced leverage? Have you secured physical? Share this video with someone who needs to understand the playbook before the window closes. Remember, history doesn't repeat, but it rhymes. Chronicles of Currency, out.